met Christy back at Vina Jetty's multifamily mastermind, and all three of us just vibe. So I'm Carly Grundmann. I'm right outside of Seattle, Washington, and I am super happy to be here. And now from our president.
Hello. So I'm Christy Schnurle, and I've been in the multifamily space now for 17, maybe even 18 years. I started in syndication. So what that means is that I worked for a firm, and basically we created funds and we rolled up multifamily, which was apartments, projects into these funds. And we focused on low-income housing exclusively to get the tax credit benefits. All of our investors were the major banks, insurance companies. So I spent 5 years at that firm. I worked in the acquisitions department. So in my role, I did underwriting, negotiated partnership agreements, due diligence reviews, all kinds of stuff like that. And that kind of kickstarted my career into real estate, which I've kind of really have just stayed in this little sector of multifamily. After that, I started working with my family's firm, which is a consulting firm, and we help developers of mostly multifamily hospitality as well. But we help them to reduce their construction costs and to build projects more efficiently. So we've been around now for over 20 years. I've been with the firm for, I think, over 12 years or something now. During that time, we've worked with, I think we worked with about 55 to 60 different projects, multifamily hospitality in 100,000 single family homes, 4,000 multifamily units, 8,000 hospitality units. So we've done a lot of volume with a lot of different developers and seen a lot of different projects and helped some of them that otherwise wouldn't exist today. We were able to reduce their costs, build them efficiently, and get them across the finish line, which was really cool. So I've really enjoyed doing that. Over the last, as I've kind of progressed in my career, the one piece that I felt like was missing that I have become more passionate about and moved towards in recent years is the investment side. So even though I've been in this space, it took and I started in the space of helping major banks and insurance companies invest into this stuff. I didn't realize that I could invest into it myself, or that other people could as well. So as I got more interested in doing that for myself, people around me, my friends, family network, I realized there were a lot of people that just don't know that this exists and what an amazing investment opportunity it is. So about a year ago, the three of us teamed up and we started Opal Equity. And the goal of that was really to raise awareness, help educate, get people into multifamily, and spread the word of like what a great way to build wealth. This shouldn't just be for all of the ultra wealthy people. This shouldn't just be a vehicle that all of the banks and insurance companies are doing all of the time. Like there's room at the table for us. So, what really drew me to Karolyn and Carly is that if we were going to be working with investors, it was really important to us that we were values aligned. So that was one of the reasons it took me a long time to move into this space, is because I felt really passionate about the fact that like, if we're taking on the responsibility of helping recommend where people are putting dollars or identifying opportunities, I want people that really care and like take that very seriously, right? And so Carly and Karolyn were a natural fit, and we share that passion. And on top of that, they're amazing people. We all love to educate and are leaders of different real estate communities, and just love pouring and giving to people from like the knowledge that we've gained and the resources and amazing connections we've been able to build. So that's really the heart and soul of Opal Equity. And that's why our tagline is learn while you earn. Because we do education, and when people invest with us, we also take them on an educational ride as well. So
yes. And you're about to go on an educational ride. Are you guys ready? And I want you guys to know this isn't the Carly, Karolyn, and Christy show. Like, we love to see your faces. So if you want to show us your faces, thank you. Thank you for everyone that does. If you don't have to. But also, if you guys have questions, drop it in the chat. We're watching the chat. There's no stupid questions here. I was very like, I've been in real estate, but I haven't been to the multifamily space before I met Karolyn and Christy, and they're like, hey, do you want to do this with us? And I was like, can I? You know, and it's so easy. And we don't realize like multifamily kind of seems like big and scary. And you hear things like accredited investor and syndication and all these PPM, and there's every single acronym for everything in the planet. And it just sounds scary. And so as I was working with them and we've raised capital for one of Vina's deals, I'm like, this is so easy. Anybody can get into this. So that's what we're here to show you guys. So if you guys have questions, drop them in the chat. Feel free to ask all the questions. And here we go. So what we're going to talk about today is 50K to freedom. We're going to talk about who we are. There we go. That is us. We've done that part already. And so what you guys are going to hear about is we're going to give you like a little stuff that if you are like, I don't know anything, we'll go over that. And then what we're going to do is show you how $50,000 can, in different scenarios, how it can compound and how you can invest that. So most people trade time for money. Like how many of you guys have a 9-to-5 job? I know that, Julie just quit her 9-to-5 job. Thanks to investing and being in real estate. But I know a lot of us still do have 9-to-5 jobs. Most of us do. And a lot of us are like, you know what? I love my job. I love what I do. But a lot of people, how many of you guys are like, I would love to not have a job. I have a job just to make life. I got to feed my kids. I got to put a house over my head. So most of us right now are trading our time for money. And that's what the majority of people do. That's what we were conditioned to think. If you're my age, I know they just shoved college down our throat. Like you're going to college and that's how it's going to do. That's how it is. You're going to get a job. You're going to work until you're 65 years old. And you're going to die. So you don't have to be that way. Passive income kind of flips the script. So if you want to work, you can. Most millionaires actually have several streams of income. So if you want to work, that's fine. The 9-to-5, that should just be one stream of income, have several. So passive income is what we're going to talk about today. That kind of flips the script. Thank you. So do we all know what the difference between active and passive income is? If they're like, give me some examples of active income. Active income is a W-2 job. What else? If you're door dashing, I did DoorDash during COVID. I know what that's like. Is that an active income or passive income? Give us, yes. Thank you so much. Joseph. Hi, Joseph. We love Joseph. Joseph says passive is rental income and active is like per hour. Exactly. So that's a good one, Jose. A lot of people are like, I want to get into wholesaling when they hear real estate because you get those big fat checks really fast. But that is an active income because you were trading a lot of time. You're putting a lot of time in. Now, I have an Airbnb that I rent midterm, and all I do is throw it up on Airbnb. This is probably oversimplified. People rent it. I cash checks. I just make sure that what I promise is there. What would you say that is? Passive income, easy peasy lemon squeezy, Joseph says. So that's more passive. There's less that I have to do. Some would say that Airbnb is active because you're always switching, but mine's a midterm rental and I have people there every 3 months. So there is like months at a time where I'm like, I'm not doing anything and they're just depositing money in my account. That is semi-passive. So what is true passive income? Does anybody have an example of true passive income? It's where a lot of us, I recognize a lot of faces in here. There's gators and stuff. There's mailbox money. That's exactly right. Mailbox money. If you're a lender, Brandy says, yes, you get mailbox money. True passive income is being like, we just did we have a raise that we did. And we have people being like, hey, I have $50,000. I'm going to wire that over to you. I'm going to go do my life. And each quarter, you can deposit whatever I make from it. And then at the very end, you're going to give me a lot more than what I put back. So that's true passive income. Okay, so let's go to the next one. All right. Not all investments are created equal. So there's different types of investments that you can do. I'm sure a lot of you guys have heard it. So there's a savings account and a CD. So that's certificates of deposit is a CD. And so you'll see the red is more risky. The green is the less risky. So it's a low risk, but a lower return. So you're going to see as you get a higher risk, you get higher return. So there's index funds, 401ks. A lot of us know that if we have a W-2 job, we have a 401k. Single family rentals. How many of you guys have a single family rental? Or even like duplex or stuff? Does any of you guys? Julie does. James does. Exactly. So that is a medium risk, but it's probably a pretty good turnaround. Short-term rentals, a little bit higher risk, a little bit higher reward. And then there's multifamily syndications. So this is one of those really big words. What is a syndication? Multifamily, I'm sure everybody knows this, but it's several doors in a building. And then a syndication is someone being like, hey, I have this 400 unit apartment building and I am raising money for it. So it's basically pooling a bunch of, so like, let's say we have something and everybody in this room has $50,000. Of those, we can be like, all right, everybody put their $50,000 in and you guys will get a return. So that is us being a syndication. We are raising capital for a multifamily deal. So it is really, 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 truly passive. And the return, so you're going to see it's a medium risk because you have to do your due diligence before on who you're investing with, their experience, the returns and everything. But you can get a medium risk with a good return, more than a CD, more than index funds, more than single family rentals, and right around short-term rentals without all the activeness of it. So that is a truly passive income. I think that's all for me.
I love it. Okay,
go ahead.
I'm going to take it from here. Thank you so much, Carly. And thank you all for hanging around. We're at 55 people in here. I love this. Thank you all for being here on a Thursday evening. I know it's back to school for a lot of you, a lot of us. And yes, I appreciate your presence here. So yes. Okay. Why is multifamily so powerful? Carly just got done explaining why we love it. Oh, we just love coming off mute tonight, don't we? Carly, you got that?
Yo les pregunté.
Okay, so why is multifamily so powerful? First, we love it because of its stability. It is one of the most recession resistant. Everyone is going to need a place to live. Families now more than ever need a place to live in this market. And that's why multifamily has been recession proof time over time again, decade over decade. Yeah, no matter what the economy is doing, people are always going to need a place to live. And then we have stronger returns, better returns, just like Carly mentioned in the previous slide. It's going to give you more returns, less risk, I should say, medium risk compared to your single family or any other asset in there. So it's going to lower your risk. It's going to appeal to more of those maybe conservative investors. Maybe some of you have raised your hand if you're on a little bit more on the conservative. You're a little bit more risk averse. You're a little bit more, I mean, there's a few of us in here that are just like balls to the walls. I'm just going to throw my money out there. I'm just going to see what works. And you're like very risk tolerant, right? So for multifamily, we like to see this because it lets us diversify. It lets us invest in something that's going to like give us a little bit more of a stable medium risk, but it's still going to offer higher returns than those savings, those CDs that are like at 5-6%, like we saw in the previous slide. And then now it's going to hedge against inflation because what are we seeing year over year? Even with single family rentals, we still see this, but like year over year, what is the rent doing? Is it going up or is it going down? Throw 1 in the chat. If it's for up, throw a 2 in the chat if it's for down. I think we all know the answer here. It is going to be rising time and time again like it's just going to keep rising. And people still need a place to live. So they're going to turn to apartments. They're going to turn to that to live there.
Yeah. And to just kind of expand on that, one thing I've been thinking a lot about lately is over the last couple of years, we've watched single family home prices go crazy, a lot of which is because the interest rates are so high, right? So it may not even be the value of the home, but because interest rates are so much higher than what they were for a while, it's pricing so many people out of the market. So people who might have wanted or want to be buying homes, they literally cannot afford to be buying a home. So if you cannot do that, then what is your option, right? It is to rent. And oftentimes that's where multifamily really makes a play. Like we have a huge housing crisis in this country.
For sure.
There is not enough supply. And as we hit things with, the economy going down, multifamily housing is really where things start to fill up because unfortunately, as people hit hard times, they then, if they have a home, sometimes they lose their home. They don't make enough, like they lose their jobs or their incomes go down. And so you downsize, right, into that. So that's why multifamily is described as kind of like this like hedge against inflation and against like it's sort of a way to balance recession type of assets. So
Exactly. Love that. Thank you for touching on that. It's so true. Like, I'm sure there's a few of you in here have tried to buy a home and it's just not happening. It's crazy out there. Okay. I'm also a renter too. So I know what that, like, I know what that is. I'm one of those people. On top of that, you get scalability. This is probably my own personal, like it's tied into my story, my journey in real estate. I love this because of the scalability. Why would I want to go hunt down 30 single family units, even if they're in the same city, or even if they're not? Like, I don't want to go around the city and manage my asset. I want to go on a one-stop shop. I'm going to an apartment complex. It's 30 units, it's 40, it's 100, whatever it is. And we have it all there. And the scalability of that, like think about that. Think of having just one 50 unit, 120 unit, right? And you have it all there. One property can impact dozens. And like, we're not thinking just as investors, we're thinking about families, right? We can help so many families in this as well. Of course, like we love the tax benefits. They're huge. We love the depreciation of this. This is where, you get to, you get the tax benefits of it. This is why we love to focus on multifamily. It checks all the boxes for our financial growth and long-term security. We get to do the write-offs. And how do you get paid? I think we're on the next slide now. How do you get paid? Okay, cash flow. It's mostly tax-free because what? We love to claim depreciation, which is basically writing off the building's wear and tear each year. And it's appreciating in value over year, but we still get to write that off. Then we have the profit at sale. So typically your investment in a multifamily can range from 3 years to 5 years to 7 years, whatever that is, that whole time. But at the end of that whole time, what comes? That comes the sale of the property, and we get a large profit at the end, and we pay all of our investors out, and everyone's a big, happy family, and we get all of our money out. And then we get to do it again. Quarterly income. This is where your mailbox money comes in, as Christy put that cute slide in there. This is what we think of when we think of passive investing. We've heard mailbox money so many times, right? Who wants mailbox money? I do. I love, let me go pick up a check from the mailbox. That shows up in quarterly distributions. And that's typically how our multifamily investments that we've been a part of, that we are a part of, they're structured in quarterly distributions. We pay out our investors every quarter and they get their mailbox money, their check. We love that. Also, I think we covered big payout when the property sells. And then you're just benefiting overall from the tax advantages and that make your money work harder for you. It's income, it's the appreciation, it's the depreciation, and it's tax savings all rolled into one. And then we're going to roll to the next slide. So who invests in these types of assets? The ones that we have been a part of in our funds. I'm a part of a 158 unit and then, oh my gosh, a 432 unit amongst my single family portfolio. So what we accept into our fund is accredited investor. Do anybody know here, is anybody accredited? If you want to throw that out there, or you understand what the credentials are, the criteria is to be an accredited investor. I know I have it on the slide here, but.
Or feel free to throw like a 2 in the chat if you thought that there was just like some fancy certificate that you get or a test you have to take, or you're just like, I don't know, I always heard that and I thought it was this big crazy thing. I know I kind of think that.
It's actually pretty straightforward, just like we've laid out on the slide here. For a individual, your income needs to meet at least 200K a year for the last 2 years, and presumably for the future, like we're predicting that you're going to be making that for the future to come, 200K. If you're married, you're filing jointly, that raises to 300,000 together year over year for the last 2 years and for the future. Or we like to base it off your net worth of at least $1 million, and this is excluding your primary home. So that is pretty much the basic requirements. I think there are other ways to qualify as a accredited investor, but these are the 2 main big ways that the majority of investors qualify as a accredited investor. I think the last one is like a really long, thorough walkthrough with the SEC, and you have to answer all these deep questions that no one really wants to do. So let's just go with the basics of, if you make 200,000 a year as a single, you're probably there if you've done that for the past 2 years. If you're married and filing jointly, you're at 300K for the past 2 years and for the future, or 1 million in net worth, which is crazy, which like, that feels like a small number now. That feels like we are probably close to that too. So yeah, this is the SEC requirement for these deals. And if you're not there yet, we can talk about that on a different time. We can help you get there, all those things, but that is the process.
Yeah, and I know one of the things, before we move on here, that I know I was frustrated with for a while, and it's one of the most common things we hear is like, this frustrates people because they're like, okay, I'm excited about multifamily. I want to invest in multifamily, but why do I have to be accredited, right? And so I do just want to say that if that is you and you are not yet accredited, that does not mean that you cannot invest into multifamily. It's just an important criteria to know, because the way that multifamily investments get structured is, and we're not going to dive deep into this on tonight's call. In the Q&A, if you want to, we could go into it more, but there's certain ways that the SEC requires you, when you're pooling investors and bringing investors together into these funds, there's a lot of different requirements. And as part of that, you're technically selling a security and you have to file different exemptions. And so one of the common exemptions is one that it's called a 506C, and it requires accredited investors. So that's why this is important to know, like, one, if you are, or if you're getting into this space and these are deals that like you're interested in doing yourself, those are the things that you're going to have to understand and to know going forward, so that you know what types of people can invest, and you as an investor know what sorts of opportunities you are able to invest into. Now, if you are not an accredited investor, there are other opportunities that are called a 506B, and it's B like Buddy. And I saw in the chat somewhere, someone asked a really good question because they said,
How
do
can
you work with sophisticated investors? So I suspect that DD is referring to a 506B, because usually what that means is that you can invest, but you need to have a substantial pre-existing relationship with the person whose deal it is. And you need to be what's called a sophisticated investor. So that means you need to understand the risks really well. You've made some other types of investments. It's a little gray area when it comes to SEC in terms of what a sophisticated investor is and what a pre-existing substantial relationship is. But those are the ways. So there are opportunities out there. So I say that to let you know that like not all hope is lost while you're waiting and working and so hard to like get to a place where then you become accredited, you can invest. There are deals that you can invest into. You just have to get to know more of the people who are running them, which is called, there's a lot of different terms for that. We call them sponsors, we call them GPs, general partners, they're the owners, operators, all these terms, they're slightly synonymous, slightly different, but those would be the people to build relationships with, because then as they get opportunities available, they're able to present them to you and you can invest into those. So that's why it's important to touch on this and that we included it here, not to discourage anyone, but so that you know what types of opportunities, and then you as an investor, what kind of steps you need to take to be able to invest into these in the future.
Beautiful. Any questions so far? We'll have Q&A at the end, but love your questions that you guys are dropping in the chat and we can answer them as we go along. But I think we've covered what an accredited investor is.
Yes.
Well, and we are going to we're going to jump into like, what does 50K mean? Chrissy's going to lead us into that.
Okay. So one of the things that we wanted to go through today is to kind of illustrate, we're going to do it not in, you're going to see numbers on the next couple of slides. You can kind of glaze over it if you want. It's really about the concept. Like $50,000 is not a small chunk of change, right? But what we really wanted to do was to help provide the perspective that, you know, it is a sum of money though that people do within their lifetime. Not everybody, but there are a lot of people where suddenly they do have that type of money available that they can put to work for them. So we wanted to explore a few options that, like, if that were to ever become you and this was a vehicle that you were interested in, what might that look like? Like, what could that do? How could that change your life, right? Because maybe there's, you know, your home, you own a home and the value goes up and you suddenly find yourself with extra equity. Or, you know, unfortunately, it's like maybe a relative passes away, you get an inheritance, or there's lots of different ways that maybe there's something unexpected. And it's by no means a small amount of money, but when you can see the power of this, it sounds very achievable. Like, what if I were able to save, or I had $50,000 and I put it into multifamily? What would that look like for me, right? So let's walk through a few of those examples. So it's really powerful because what it does is over time, it creates this snowball effect. And you can reinvest that one investment. So what we did here is we took like the average multifamily investment can range anywhere. And this is very general. This is going to depend on the type of investment, the market, what the business plan is, but like a very average return would be in like the 12 to 18% maybe. It's a little lower right now in this market over the last year or so. But so we took a very conservative number and said, what if the average was like 12%? Okay. And we're just using that as an assumption across the board. And we said, you got $50,000 investment, you invested into a multifamily opportunity. It performed as expected at around 12%. So that means that each year you were getting about $6,000 in distributions. And let's say you just hold on to any money that you're getting. In this, we kept it super simple. Hopefully you're at least sticking that in a high yield savings account or doing something with it. But we're just going to assume that it's just going into a bank and not earning anything. Now, let's assume the hold period for this investment is 5 years. Okay. So at the end of the 5 years, you get what Karolyn talked about earlier. The majority of the money is going to come. That's when you're going to get your return of, or you should. I'm not going to say you are going to, because, you know, it's an investment. There's never guarantees, but ideally you receive your capital back and then you're getting the majority of the profit at that point. And so upon that, let's say you decided, okay, I now got my money back and I got everything I just earned over the last 5 years. I'm going to take all of that. Now I have $80,000. I'm going to take that $80,000 and invest into another multifamily deal. You're going to keep those dollars rolling. Okay. You're not going to spend it. You're not going to use it. You're going to continue to just let it go. So you're going to rinse and repeat, right? You're going to let that build up. You're going to save all those distributions. You're going to see how those are getting bigger each year. And then at the end, you're going to invest. Now you have 128,000. So let's say you invest that into another opportunity, or maybe it's multiple at this point because you're diversifying a little more, even across, you know, investments for multifamily. Now you're getting 15,000 a year in distributions that are coming off. Then at the end of that one, you're sitting on over $200,000. Now this is the same. You didn't save up extra money. You were not sitting there like doing anything crazy. You're just rinse and repeating the same exact strategy. You came up with the 50,000 originally, and you were just keeping it busy. You were like, nope, you were going out, you were working for me, you were making more money. Okay. And you put it in. What that would look like over 20 years is over $300,000, which is kind of cool to think how much it grew, and it's just 50,000, right? To start with. Now, what this example, and I'm going to go through a couple of other examples like this, like, okay, if it wasn't just 50,000 the one time, if it was, you know, different scenarios, but what this does not include, as I mentioned, is one, earning additional, because if it were me, I would be taking those distributions and I would be investing those as well in the meantime, and then pooling everything, right? So your earnings should be higher than that. What it also doesn't include is the tax benefits. That's really hard to model into these scenarios. But one of the most attractive things about multifamily investments for most investors really is the tax benefit. The reason for that is because it creates what's called a tax shield. The depreciation is so much higher on something like multifamily that you can basically, everything you're earning, or maybe not everything, but a good chunk of what you earn on that investment, from an IRS standpoint, they look at it and they go, oh, you had losses. Like you didn't earn money. So you're getting physical dollars put into your bank account, but on paper, you're losing money. And what that does is it means you finally get to move up, like your income bracket is moving up, you're making more money, but you're not putting more of that money out the door by paying taxes. You're protecting it. So maybe at the end, it's like, if you have like 30% depreciation or something, that means that like you're protecting a good portion of those returns that are coming back to you. They're offset by depreciation. So I don't know if that makes, I know that gets a little bit confusing for people sometimes, exactly how the depreciation works. And it's a little bit more complicated and in depth when we're talking about passive versus active income. So we can certainly go into that more if you guys have questions. But I did just want to note that as we're going through these, this is really like the elementary version of a scenario, and it's not taking in the full power because those get a lot more complicated. And from a modeling perspective, I don't want to put you guys through that. So this is the simplistic version. And in my opinion, it's still really inspiring and exciting to think about. Okay, so scenario B, let's say that you are able to set aside, like maybe you're doing other real estate, or maybe you're getting bonuses, or maybe you're good with saving, or whatever the scenario might be, or you have a side hustle, and you're able to set aside $10,000 per year, which means that every 5 years you've saved up another little nest egg of 50,000. So you make your first investment of 50, and then each year you're saving up 10. Now what you're doing is reinvesting everything that was already working for you. So you have that same 80,000 after the first 5 years. Now you just added 50, right? So maybe it's 2 investments and you get it going. And then you continue to do the same things. So you're like, okay, every year I'm going to save $10,000 that gets added to this pool that I'm also investing. Okay. So what you do that by making 1, 2, 3, 4 investments over the course of 20 years, by saving $10,000 a year, you're up to almost $750,000. Again, you have not put any of these dollars to work in the meantime. This is like sitting over here not making money, which is not a real world scenario, right? You have tax benefits, you have all these other things that are happening. So really this number is probably much higher. So that's scenario B. Total investment to get to here in 20 years was only $200,000. And I say only like that's, I don't mean only like that's a small amount of money, but if you think about it in the sense of like, okay, is there a way that me and my family, like if I want to do this and build this kind of wealth, is there a way that I could save $10,000 per year and set that aside? Maybe it's not achievable now, but maybe in the future, or there's a strategy or something extra you can do to implement that. And that's why I say only, because for a lot of people, that feels like a goal that maybe it's a little bit of a stretch goal. but it's not something that feels like, oh, I need to wait for this windfall of like unexpected money to hit my lap, or I have to wait till I'm some millionaire to do this, right? It's a very achievable goal for many people if they set it as their goal. And then, whoops, okay. And this just really just outlines same scenario, but instead you're sort of accelerating it. So you're like, okay, I'm able to save a little bit more. I can save about 15,000 a year. Okay. So you're investing, you're adding another investment every 3 years, and it gets a little more complicated because of the hold periods and things. But in this scenario, you end up with like $1.5 million, which is a pretty good chunk considering the total investment there is 350,000. Going through those scenarios, we just wanted to kind of leave you guys with a little bit of inspiration. Like in 20 years, if you were any of those scenarios, would that be life-changing for you in any way? What would look different for you, right? Is there something you could do in 20 years if you were able to get to a point where you had this nest egg that was 350 or 750 or $1.5 million that was sitting there in addition to whatever else you're doing, or if that was your full strategy? Like, what would that look like for you? Would that change your family in any way? Would that change your legacy? Would that allow you a different sort of a life? Like, what would you do? So we just kind of wanted to leave you with that. And this was really intended to be, hopefully, I know that we've dived into some things that are a little bit more complex and if a little bit more numbers or technical, but we tried to keep it really basic, really intro, just to kind of open up the doors. Like if this is something that's brand new to you, we don't want you to feel super intimidated by it. And we'll continue to kind of dive deeper in the future. But what we can do, and the only reason that we were sharing that last slide was so you guys could grab the QR code if you wanted. But we just wanted to have this be a way that you're able to ask questions. If there have been burning questions or something you've been curious about, we kind of gave you guys a little overview here. Feel free to let us know tonight if you have questions. We're going to open it up. If multifamily, if you're super interested and you've been like, you know what, I have been thinking about investing into this kind of thing, or like I might in the future, but you want to have more of a conversation and just dive a little deeper for like your situation or see if it's kind of a good fit, these types of things, we're happy to get on calls with you guys. So I did have the QR code up there, but I can drop in the chat. It's the opalfund.com/meet. You guys are welcome to book a call with us, and we can do a little intro call and just understand what your background is and answer any questions. To be clear, like this kind of a thing I love it. I love multifamily as an investment because it's risk adjusted, great tax benefits. I think it's a beautiful wealth builder, but that doesn't mean it's the right fit for everybody. And even within multifamily, just like real estate, it doesn't mean that like there's all different types of fits, right? Some deals are completely different. Like I like conservative because I came from a background of underwriting for banks. Okay. So it's kind of baked into my bones a little bit, but there's stuff that's a lot more of a bigger play. There's a lot of things out there. So sometimes it just takes kind of understanding or having conversations with people to understand what's available and for you to figure out what your goals are and what kinds of things are a good fit for you. So,
Richard had a good question. He says, are you guys going to is there anything that you guys are going to raise capital for later or a product? What did you say, Richard? Is there a future plan to pool money and invest in a product? That's a great question.
There will be. There's a huge, we didn't touch on this. We should have touched on this. But like there's like I think it's like a $380 billion of multifamily that's coming down the pipeline. There's been stuff going on in the market for the last couple of years, which some of you may know, where because of interest rates and everything and interest rate caps expiring, like there's stuff that's underwater right now and upside down that in the next 18 months, we have a lot of stuff happening with debt that's expiring and assets that need to get rescued. So there's going to be a huge opportunity to get into multifamily and likely at a discount. So we are paying a lot of attention and talking to a lot of very experienced operators. Because the thing is, a lot of this stuff too is going to happen behind closed doors. So some of these deals are not going to be on the market and things that most people can get into. It's going to go to people who've been doing this for a decade or so, and they have relationships with other operators or with brokers where it's very hush hush, because a lot of the stuff they don't want trading, on the market. So the key really is those relationships. So yeah, I feel very confident that there will be. We are very actively looking for a fit. We say no to almost everything. But yes, if it's something, you're interested in, that's another reason too. We love to talk to you guys to hear, like, what are you looking for, right? Like, what kinds of returns, what kind of risk level? Because it better helps us to go out. We know what we like and we're looking for, but we also take into consideration the people that want these, what's working there too.
And I want
And
to, oh, sorry.
oh, that's okay. I was just going to quickly just say, because I know there was questions earlier, like, oh, do you work with, non-accredited investors? And I think we briefly touched on that, not yet, but that also is something that likely in the future, we will certainly be probably part of opportunities in which we will be co-GPs on opportunities that allow us to bring in unaccredited investors. It's not in our short-term plan right now with what we're doing, but it is on our horizon. So that's another reason that we love to build relationships, because we want to make sure we have as many as we can so that you guys have access if those are things that are of interest. So
And
that's
another thing, what you guys can do. So one, we will, and it's good that we have a relationship with you now, so we can bring you in as if you're not accredited. But another way you can get in is raising capital for very experienced people. I think we should do a whole Zoom, you guys, on, because Christy says we almost always say no. And I think we should talk about why. But we do talk about this in, we have a little course called the Funds Formula. So people that want to learn how you can put a fund together, where it's like you get a PACE or you get a VINA and they have something and you pool your money and raise capital for them with accredited investors for equity. That's another way you can do that. So if you guys are interested in that at all, we dive deep into that. That's the funds. It's fundsformula.com or funds formula. It's just our little course on how we set up our fund to fund. Here, I'll put it in here for you, Richard. And
I
it's
put it in there earlier, but drop it again.
okay, fundsformula.com. But if that's something you're interested in, is like really diving deep on how we set up our fund, like what we're looking at. We have a whole like legal section on, and then another section on like why we almost always say no to people. Because when she says that, because we have a very good reputation that we want
Very
to,
picky.
we're very picky. And if we're going to tell people to put money in something, we're not doing it just to get, some people will just do it to get equity. Like we're like, do we trust you? What's your experience? What have you done before? We want to talk to your attorneys. We want to see everything. Like we want to, if you guys are Gators, remember how we talk in Gator about vet before you lend out money? Same thing with raising money. Before you take anyone else's money, you better vet the people that you're raising money for. So, and it's not like, oh, well, I saw Joe Blow on YouTube and he has 8 million followers. That is not an indicator. So we go into that if that's something you guys are interested in. Sorry, that was a tangent. That's one way that you can wedge your way into a deal, is being like, hey, Vina, hey, Pace, I know you have this thing and I want to be I asked Pace, I'm like, are you doing funds of funds? I asked his sub 2 fund and they're like, yeah, we will. So maybe that's a fund to fund situation. So
I'm gonna speak to that for a second, because Richard mentioned something earlier in the chat of like, is it okay? So we can start out small, right? Like, I think you mentioned that, Richard, right? Like, it's okay to start there. And I can attest to that, because this was back in 2022 and I was like starting to get my mind wrapped around multifamily. This was not that long ago for me. And I'm like, I know there's something here. I know it. And we went through the whole thing of like, I'm GP on several deals. And I went through the calling, the underwriting, the broker calls, the negotiations, the contracts, this, like every single thing, the raising of the cap, like all those things. And we got a 30 unit and we got a 40 unit 2 months apart in a 6-month period. That's crazy, but it's achievable. It can be done. We did it on seller finance. And then that was like, ding, ding, ding. That's when my mind went off. I'm like, okay, here's scalability. This is what I'm looking for. This is where I'm supposed to be, because I don't want to be playing ring around the rosy with all due, like, I'm not that person. I don't want to go around to single families here and there. Yes. Do we have some? Yes, we do. Is it where I want to put all of my energy and effort? No, because I understand the longevity and the impact of creating wealth passively and the generational impact of what multifamily can do for us. So that's where my lane has been for the past 3 years. Now that I understood what a GP was and all of the inner workings, if I think there's a few in here that say they're a GP or they're working to be a GP. Throw one in the chat if that was you. I don't remember your name. But it's a lot of work. It's a lot of work. And then when we had the opportunity to be a part of a 400 plus unit in 2023 to raise capital, like what Carly was mentioning with a fund of funds, I said, okay, yes, this is my next step, because I'm not at that moment of ready to throw out 100K to passively invest yet. I'm still like learning my bearings. Right. So that's what I did. And that's how I scaled even more. And that's where we brought the team together. And now I have over 600 doors by understanding that. And the majority of our investors, they start passively. So they understand what it takes, what it looks like inside a multifamily. And while we're hosting these educational Zooms, and they're just learning from a comfy chair while they're collecting their mailbox money of what this asset is doing for them and their bank account. And then they're like, oh, I have a little bit more proof. I have proof in this. I have a proof of concept. Now I feel a little bit more ready to take the next step and be a little bit more active, or be a fund to fund, or do side by side. Maybe you have the flexibility and capabilities to diversify that way and put 50K, 100K into a passive investment, while still, I want to do my own. I want to do my own fund and raise on my own asset, or whatever that looks like for you. There's so many options here, but I'd say the majority of our investors start in that passive role, and then they branch out and they learn the landscape of this and build their resume as they go along. So yes, big advocate for this. I hope that answered the question for you, Richard.
Can I piggyback off of that? We were doing, what Zoom are we doing? Oh, we have a networking Zoom. If you guys are interested in the networking Zoom, we have a networking Zoom. And if I don't know if anybody were on that last networking Zoom, but we had one guy named Lee come through our, Joel was in there too in our Funds of Fun formula course. We did it live and then recorded it. And he has already found and gotten into a whole deal because of that. I don't know if he's accredited or not, or how he did it, but he has taken that knowledge and wedged himself into deal. I can't remember if he wedged himself into a deal or if he bought the deal. But if that's one way to getting there, is just learning from those experienced people and raising money for them. Someone says, what's the difference between what Vina does? So what Vina does is she's the operator. She finds the deal. She has a team. She underwrites the deal. She negotiates the deal. She closes the deal. She does everything. She runs the whole multifamily. And what we do is we're like, hi, Vina, we have a bunch of friends with a bunch of money. We're going to pool this money together in our fund. And as Opal Equity, we're going to invest in your fund. And everybody that invests with their money will get a return every single quarter and a payoff at the end, depending on how much they make at the end. So.
I love it. Would you unmute Christy, the way, Carly?
Yeah.
She has
sorry.
Yeah, she has the silencing powers here.
No, that was my bad. I clicked the mute and then I realized I was like, oh, I don't have the power to unmute myself. Like I usually do.
Everyone's power's away after that. Abel came in and shared their screen. I'll fix it for the next one so everyone can.
No worries. I think we had a couple of other questions that were in here that were good. Like Julie was asking, so you buy multifamily but sell to buy something else. You don't hold multifamily. So there are different strategies, but I'll briefly touch on this because I think a lot of people do think about like, oh, you get a multifamily and amazing, it's cash flow, and you just like hold this and you just collect the cash flow. You could do that. I will say in the multifamily space, especially in the commercial, when you're getting into the much higher unit counts, a lot of the strategy of where the money, the big money is made for those returns is on what's called the exit. So it really is like when you sell, when you go through. Because one of the things that we didn't really touch on that we also really love about multifamily is that you can force appreciation. So with a single family home, you could do a flip, right? But a lot of the value is going to depend on what did the neighbor down the street that has a similar home sell it for, right? It's very market dependent, comps, distance, time dependent that your value is depending on. With multifamily, it's a little different because the majority of the value is looked at from like it's a business. So even though it's technically real estate, you're getting also this cool comparison where they're like, yeah, but we're going to decide how much it's worth as a business. And then buy it. That's how you're like buying and selling is what that value is. And you're looking at what's called NOI, which is your net operating income. So how well can you run this business? You're getting money from these different sources like rent or other income streams at the property. What are your expenses like? Like how efficiently you run it determines how much it's worth. And the reason that's really cool is because you could force that appreciation and push up the value in a shorter period of time instead of sitting and just waiting and being like, okay, this area is going to grow. So in 10 years, I think it's going to be worth a lot more. It's like, no, you could really quote unquote, like flip it within, a handful of years there. But because that's the play in multifamily, a lot of time there's a bigger investment needed up front for these, right? Like to execute that business plan and to actually purchase. So you have much bigger dollar amounts that are going in to be able to do these renovations, to be able to add amenities or to whatever's going on there. And so even though they cash flow, a lot of the time they don't have huge percentages they're cash flowing. Like, you're not going to see like, oh, 30% of it's every year is probably going to investors. It's probably going to be much smaller because you also have debt that you're paying. You have all of these other expenses. So really it's that forced appreciation and all that extra equity that you build that then when you sell or you refinance or you're doing something that you're calling the exit, that's when a majority of the money is made. So that's the reason why a lot of people don't continue to hold it. Some will be like, oh, payback investors, give them a great return and I'm still going to hold on to it. If it was like a refinance, that could be an option, but that's not always the play. So hopefully that makes a little bit of sense. But if not, then just let me know.
Great question. Great answer.
Yeah. So let us know what you guys are looking for. We'll do more Zooms of this. We want to spread our knowledge. We want to open up our brains so you can walk around in there and learn.
Yes.
Don't
I
pick.
know we're at the top of the hour. We appreciate the questions and everything. Carly has dropped Zoom in the chat for our networking Zoom that we do once a month, maybe more if we're lucky, maybe. And we'll also be alternating with these.
Started that we're excited about.
Yes, Richard, need to learn and earn. Exactly. We love this.
Yeah.
It feels daunting and overwhelming, but when we get to break it down, and I am speaking to that myself, like when it's broken down and we can understand how one tiny step makes a ripple effect of change in our life and everyone else's, like it's incredible what you can do. So don't get too hard on yourself. Don't get down. You're in the right spot. Thank you for being here.
Thank you for being here, you guys. We are so honored that you guys even want to show up and learn from us. It's so honored. We're honored. And we want to let us know, you guys, like send us a DM on Instagram, send us an email, send us whatever, send us smoke signals and be like, I really want you to hop into this, or I'm working on this and I want to learn more. So let us know. We want to give back. And
yeah. And let us know what you guys want to learn because we'll do another one of these and we can go any direction with it. We can keep it super basic like we did. We can do it as just a complete open Q&A the whole time. If you guys have like burning questions, just want to bring and just like ask us whatever questions, we could do that. We can go into vetting. There's so many different things. So reach out to us. All of our names on, if you're not following us, these are our handles, I think, on all of the different platforms. You can also contact us on our website, theopalfund.com. There's ways to contact us there. And yeah, thank you so much, you guys. Did anyone learn anything new tonight at all? If you did, please let us know if this was worth your time.
Let us know, make a post about it. That is like love language for us, when you're taking a little nugget that you learned and sharing it with people who weren't able to be in the room. That is a big fat love language for us, and we adore you for that. For people asking, yes, this is recorded. We will need to make some serious edits because we need to do that, but we will send out the slides in the meantime. And yeah, keep everything above board for everyone.
Yes. And
do you want to do a quick photo if people want to turn on cameras?
Yeah, let's do
we
that.
always like to take a photo of our groups and be like, look how many badasses are here.
Seriously. So if anyone wants to turn on a camera, if you want to
here.
Photo.
Hey. Have a good night, everyone. We appreciate you.
Have a good night.
Bye.
Okay. Thank you.